I still remember that week in January like it was yesterday. The market didn't feel like a market anymore. It felt like a battlefield where the rules had suddenly disappeared. I was sitting in front of my screens late at night, watching GameStop explode in real time. A stock that had been written off as a dying relic of the past was moving hundreds of percent in a matter of days. No earnings, no turnaround story, no fundamental miracle, just price. Raw, violent, irrational price. And for the first time in my trading life, something felt different. This wasn't a hedge fund flexing its muscle. This wasn't smart money quietly positioning months in advance. This was retail traders, people trading from bedrooms, basements, phones during lunch breaks, standing up to Wall Street and screaming, "We're not your liquidity anymore." At least that's what it looked like on the surface. The headlines told a simple story, a rebellion, David versus Goliath, small traders uniting, squeezing billion-dollar hedge funds, breaking the system. But the market never tells simple stories. And whenever something feels emotional, viral, historic, that's exactly when a trader needs to slow down and ask a dangerous question. What's really happening underneath all this noise? Because behind every moment that looks like freedom, there's usually another layer of control you can't see yet. Back then, I wasn't watching GameStop as a participant. I wasn't chasing the move. I wasn't cheering or shorting. I was watching the structure, the order flow, the reactions, the fear, the arrogance, the panic. And what I saw wasn't just a short squeeze. I saw a mirror showing everything retail traders secretly want: power, revenge, validation. And at the same time, a mirror showing everything that eventually destroys them. But to understand why GameStop mattered, and why it still matters today, we need to go back to the mindset that made this explosion possible in the first place. Because GameStop didn't start as a rebellion. It started as pain. Pain that had been building quietly for years. I've met thousands of retail traders over the last decade and a half. Different countries, different accounts, different markets, but emotionally they're all carrying the same weight. The feeling of always being late, of always being on the wrong side of the trade, of watching price move perfectly after you get stopped out. They don't just lose money, they lose dignity. And when you lose often enough, you stop asking how to trade better. You start asking who to blame. Market makers, hedge funds, brokers, the system. GameStop became the perfect outlet for that anger. Here was a stock where hedge funds were massively short, publicly, aggressively, almost arrogantly. It looked like a rigged setup begging to be punished. And when retail realized they could force a squeeze, it wasn't just about profit anymore. It became personal. I remember reading posts from traders who weren't even asking how high GameStop could go. They were asking how much pain they could cause, how much damage they could inflict. Some of them were fully aware they might lose money, and they didn't care. That's not trading. That's something else entirely. And that's where the real mistake begins. Because the market doesn't care about your pain. It doesn't reward justice. It doesn't punish arrogance on schedule. It simply transfers money from those who misunderstand risk to those who understand it better. Many retail traders believed this time was different, that unity could overpower capital, that collective belief could rewrite market mechanics, that hedge funds were trapped with no way out. But belief doesn't move markets forever. Liquidity does. And while retail was focused on memes, slogans, and screenshots of unrealized profits, the deeper forces of the market were already adjusting. What most people didn't realize is that by the time GameStop became a global headline, the smartest players were no longer emotional, they were surgical. They weren't fighting retail, they were positioning around retail. Because the moment emotion enters the market, edge quietly leaves the room. I watched traders who had never held a winning position suddenly sit on life-changing profits and refuse to sell. Not because of strategy, but because selling felt like betrayal. Selling meant giving up the dream. Selling meant admitting this was still just a market, not a revolution. And that's when hope turns into risk. Not the kind of risk you can measure with a stop-loss, the kind of risk that lives in your identity. GameStop didn't just test trading accounts, it tested ego. And markets are ruthless when ego shows up uninvited. What came next wasn't an accident. It wasn't manipulation in the way retail imagines it. It was structure doing what structure always does when volatility explodes and liquidity becomes uneven. But before we talk about mechanics, short squeezes, and the invisible exits hedge funds used, we need to slow down even more. Because the biggest loss in GameStop wasn't money, it was the moment retail traders confused being right with being invincible. And that confusion has destroyed more accounts than any hedge fund ever could.
There's a moment in every trader's life when loss stops being financial and starts becoming personal. For many retail traders, that moment arrived right after GameStop peaked. Not at the top, but just after. I watched the shift happen almost instantly. The same traders who were celebrating unrealized gains a few days earlier were now refreshing their screens in silence. No more memes, no more slogans, just price pulling back, slowly at first, then violently. And that's when the real pain surfaced, because the mistake wasn't buying GameStop. The mistake was believing that price owed them something. Retail traders weren't wrong about one thing. Hedge funds were over-leveraged. Short interest was dangerously high. The squeeze was real. The move upward made sense, structurally, mechanically, mathematically. But what retail misunderstood was far more subtle. They believed the market would finish the story the way they imagined it. They believed hedge funds would be forced to cover at the top. They believed brokers would remain neutral. They believed liquidity would magically stay available while price went vertical. Markets don't work like that. Markets don't resolve conflict in dramatic finales. They resolve it quietly, efficiently, and unfairly. The pain wasn't caused by the drop. The pain was caused by hesitation. Retail traders froze because selling felt like giving up meaning. Holding felt noble. Exiting felt like betrayal, not just of the movement, but of themselves. I've seen this psychology before, many times, long before GameStop. It shows up in bubbles, crashes, parabolic moves, and cult stocks. The moment a trade becomes part of someone's identity, risk management quietly disappears. GameStop wasn't a trade anymore. It was a statement, and statements don't have stop losses. That's when the real damage was done. Because while retail traders were emotionally locked into one narrative, the market had already moved on to the next phase. Volatility was being repriced. Options chains were being recalibrated. Market makers were hedging dynamically. Liquidity providers were widening spreads. The game had changed, but retail didn't notice. They were still fighting the previous battle. This is the part no one likes to talk about, because it ruins the fantasy. Hedge funds didn't lose the way retail imagines. Some funds took damage, yes. Some made mistakes. Some exited badly. But many adjusted. They restructured positions. They shifted exposure. They let time and mechanics do the work. Retail traders, on the other hand, had only one weapon: conviction. And conviction without flexibility is just delayed loss. The most painful messages I read during that period weren't from traders who lost money. They were from traders who almost won. People who watched accounts grow tenfold, then round trip back to nothing. That kind of pain stays with you. It teaches you a brutal lesson. The market doesn't reward bravery. It rewards timing, structure, and restraint. That realization doesn't come easily. It usually comes late. And it often comes after a trader swears, "This will never happen to me again." That's where the revelation begins. Not in the charts, not in the headlines, but in the quiet moment when you finally admit something uncomfortable. Retail didn't lose because hedge funds cheated. Retail lost because they misunderstood where power actually lives. Power in the market isn't loud. It doesn't chant. It doesn't hold signs. Power flows through liquidity. Once I started looking at GameStop through that lens, the entire story changed. What looked like a rebellion started to look like a lesson the market has taught many times before, just in a louder, more public way. Short squeezes don't end when shorts give up. They end when liquidity runs out. And liquidity always runs out on the side with fewer exits. Retail believed unity could replace structure, that emotion could overpower mechanics, that being right together meant being safe together. But markets don't move on belief, they move on imbalance. When price accelerates faster than liquidity can support, something has to break, and it's almost never the side with deeper pockets, better tools, and fewer emotions. The true awakening for me wasn't seeing hedge funds scramble, it was realizing how perfectly predictable retail behavior was under pressure. Hope at the top, silence on the way down, anger at the bottom. That pattern hasn't changed in 100 years. GameStop just broadcast it in real time. And once you see that pattern clearly, something shifts inside you. You stop asking how high something can go. You start asking who still needs liquidity and who's already found their exit. That's the moment a trader stops being entertained by the market and starts respecting it, not as a battlefield, but as a machine.
Once you strip away the headlines, the slogans, and the screenshots of unrealized profits, GameStop becomes something much less romantic and far more educational. At its core, GameStop was not a revolution. It was a stress test for liquidity, a stress test for market structure, and most importantly, a stress test for retail psychology under extreme conditions. Short squeezes have existed for as long as markets have existed. They're not new. What was new was the scale of retail participation and the speed at which emotion propagated through social media. Price didn't just move, it echoed. But price alone doesn't tell the full story. The real engine behind GameStop wasn't buying stock, it was the options market. When retail traders piled into short-dated call options, they unknowingly pulled a lever most of them didn't understand. Market makers who sold those calls were forced to hedge by buying the underlying stock. That buying pushed price higher, which forced more hedging, which pushed price higher again. This wasn't rebellion, this was feedback, a mechanical loop where delta hedging amplified price movement far beyond what normal demand would justify. Retail didn't overpower hedge funds, they triggered a system response, and systems don't care who pulls the lever. What most traders missed is that this loop works both ways. As price accelerates upward, hedging pressure increases, but once momentum stalls, that same hedging pressure unwinds, quietly, relentlessly. Liquidity that appeared on the way up disappears on the way down. That's why GameStop didn't collapse all at once. It bled, it snapped, it trapped. From the outside, it looked chaotic. From the inside, it was perfectly structured. I watched order books thin out as volatility exploded. I watched spreads widen. I watched execution quality degrade. Those are not accidents. Those are signals that the market is protecting itself. Because when volatility spikes, someone always pays for it. Retail traders often think of liquidity as something infinite. As long as there's volume, there must be buyers and sellers. But liquidity is conditional. It exists only when participants are willing to absorb risk. During GameStop, liquidity providers didn't disappear, they repriced risk. They demanded more compensation, and when retail refused to sell because selling felt wrong, liquidity shifted to the other side. This is where the insider thinking diverges sharply from retail thinking. Retail asks, how high can this go? Smart money asks, where does this break? Hedge funds don't need to win the narrative, they need to survive the mechanics, and survival often means letting volatility burn itself out while positioning for the unwind. Some funds were hurt badly during the initial squeeze, that part is true, but markets are not decided in the first act, they're decided in the aftermath, when attention fades and structure reasserts itself.
The most important case study from GameStop isn't the peak, it's what happened after. As retail attention moved on to the next symbol, the next promise, the next dopamine hit, price was left without a crowd to support it. And without a crowd, liquidity becomes unforgiving. This is where the real transfer happened, not from hedge funds to retail, but from emotional traders to patient ones. GameStop exposed a truth most retail traders don't want to face. Being early and being right are meaningless if you don't know how to exit. And exits are not about courage, they're about understanding who still needs you. Every market move is a negotiation between urgency and patience. Retail traders tend to trade urgency. Smart money trades patience. That's why the loudest moments in the market are often the least profitable in the long run. GameStop wasn't about unity. It wasn't about justice. It wasn't about beating Wall Street. It was about leverage, feedback loops, and the illusion of control. Once you understand that, the story stops feeling emotional and starts feeling instructive. And that's where the real edge begins, not in fighting the market, but in seeing it clearly without needing it to mean something more than it is.
If GameStop taught me anything worth keeping, it wasn't how to squeeze a hedge fund. It was how to see myself more clearly inside a trade. Because every lesson in that episode points back to one uncomfortable truth. The market doesn't punish ignorance first. It punishes attachment. The first application is learning to separate meaning from mechanics. A trade should never carry your identity. The moment you need a trade to prove something, to yourself or to others, you've already surrendered your edge. Price doesn't move to validate beliefs. It moves to rebalance risk. The second application is understanding where liquidity actually comes from. Liquidity isn't volume, it's willingness. When everyone wants the same outcome, liquidity becomes fragile. That's when exits matter more than entries. Before entering any trade, especially one driven by emotion or narrative, you should ask a simple question. If I needed to get out quickly, who would take the other side? The third application is respecting structure over stories. Narratives are loud. Structure is quiet. Options flows, volatility regimes, and market maker behavior don't trend on social media, but they decide outcomes. If you don't understand how feedback loops form and unwind, you're not trading price, you're trading hope. Finally, there's discipline, not the motivational kind, the boring kind. Position sizing that feels too conservative, exits that feel too early, rules that protect you from your best ideas. Those are not signs of weakness, they're signs that you intend to stay in the game long enough to matter. Retail traders don't fail because they lack intelligence. They fail because they underestimate how persuasive emotion can be when it feels justified. GameStop didn't expose market manipulation. It exposed how easily conviction can replace caution. And once that happens, risk stops being measurable. The quiet lesson of GameStop is this. Markets don't reward rebellion, they reward clarity. Retail traders didn't lose because they challenged Wall Street. They lost because they confused participation with power. Power in markets isn't about numbers or noise, it's about control over exits. Every generation gets its GameStop moment, a symbol that promises something bigger than profit, a trade that feels like history, a chance to finally be on the right side. Most traders mistake that moment for opportunity. In reality, it's a test of whether you can stay grounded when everyone else is floating, a test of whether you can step away when holding feels heroic, a test of whether you trade the market or let the market trade you. If you take anything from this story, let it be this: survival is the first victory. Everything else comes later. If this perspective resonated with you, stay with this channel, not for hype, not for shortcuts, but for clarity, the kind that only comes from seeing markets as they are, not as we wish them to be. Leave a comment with your own takeaway from the GameStop story. And if you want to keep sharpening how you think, not just how you trade, subscribe to Staro Trading, because mastering the market always begins with mastering yourself.